Thank you and welcome everybody. Look at this first page and it just says from Wall Street to your street, migrating retirement accounts to real investments for a secure future. I think something very interesting with respect to what Wall Street's offerings are considered today and what anything else is considered. And if we look at real estate in today's investment world, or real estate or gold or any of these tangible assets really, what are they considered in Wall Street terms? They're considered alternative assets. And I think it's really interesting how something that is really the oldest, most dependable, most solid, tangible things are now considered alternative investments, where we have all these other sliced, diced things that are real investments. Does anyone know what Chase got in trouble investing in a few months back? Was it 6 months ago, probably now? Part of what caused the whole big collapse in the first place was what? Derivatives, right? So Chase got in trouble a few months ago for synthetic derivatives. Well, what the heck's it? A derivative is one thing. How about a synthetic derivative? And yet that's an investment, a normal investment in Wall Street terms, and real estate is an alternative investment. I think that's something that's sort of puzzling. It's definitely puzzling to me. But so my sort of campaign in today's world, at least when we look at our businesses and the way we present the people and the items that our clients buy, I consider them real investments. Capital R, capital E, capital A, capital L. I mean, that's what I look at. A piece of real estate, if it's debt-free, it's not going to go away unless you just simply don't pay the property taxes. I mean, that's really the only way it's going to go away for you. So most of the people that come into us, they want something they can depend on. A lot of them want to be able to drive by that thing. They want to see it. They know it's there. And we're going to talk about a variety of ways to make those investments happen. But, from Wall Street to your street, migrating real investments for a secure future. People come in, and I've got people that will do a self-directed account. They'll buy a safe. They'll put the safe in their house. They'll go buy gold, put the gold in the safe in their house. It's not necessarily what I would do, but if that's what makes them comfortable, that's what they're going to do. And they can do that with these accounts. So when we look at self-directed accounts and the accounts that we structure for people, our accounts will allow you to truly self-direct. They will allow you to make any investment the law allows. And we're going to talk about what few restrictions there are during the next couple hours. But we're going to get in, start off with basic rules, start off talking a little bit about real estate, some different things, talk about why people are doing these things, go over the do's and don'ts, and we're going to finish up with about a half dozen examples of transactions people have done in the last year or so. All right? Invest in what you know. Recession investing requires that you solve someone else's problem. You recognize that from yesterday. I put that in our 1031 presentations today. I put that in these. It's sort of a different context when we're looking about retirement accounts and our clients and what they're doing. Most of our retirement account transactions, if they're buying real estate, are cash transactions. That's not to say it has to be, but most of them are. So if we look at situations where maybe a contractor was building a property that ran out of money, and now it needs the kitchen completed, it needs bathrooms completed. I know there's new loans that will allow those things to happen, but traditionally, you can't get that financed. Well, we've got clients that will go in there, buy that thing outright, because they have the money to. If we look at why the market's slow today, it's really the lack of liquidity is due to lack of money for the market. There's trillions of dollars on Wall Street in retirement money, and it's just a fraction of that. Less than 2% of it's in real estate. So by anyone's diversification model, I think that's a little bit lean. So we started looking at what people want to do. We look at this, and I think, really, if you can make a deal happen today, it allows somebody else to sell a property. And maybe they're drowning in that property. It allows them to move on, too. You get an opportunity, they get an opportunity. It's good for everybody. Think of one real estate transaction, all the different people that are involved with it, a single transaction. You've got appraisers, inspectors, brokers, title escrow, finance people, will be involved. I mean, just Home Depot's involved. I mean, it's just endless of different layers of people involved with a single transaction. Those transactions are just, we're talking a tiny percentage of them are happening today at work. So Probably never thought you'd see IRA and sexy in the same sentence, but there you go. That's a Wall Street Journal article. It was actually almost a year ago now, March. But, it's interesting. The mainstream press is starting to acknowledge, hey, this is something that's possible. And let me say this, self-directed accounts, they're not new. It's been possible since the beginning of retirement accounts. So the mid-'70s, all of this has been possible. Nothing's changed. The rules haven't changed. It's just something that the market's sort of dictating a change there. People are wanting to do other things. And the more people are aware of what they can and can't do, the more they're going to do it. You look at tax-deferred exchanges. They've been around since the 20s. And they really just sort of hit their stride in probably the mid-late 90s is when they really became something prominent in the marketplace. When I started Equity Advantage with my brother in 1991, I'd walk in to a room, and I had a little more hair on my head in those days, but I was a pretty young guy. And people look at me like I was, doing something really funny. I mean, it was a strange topic for them. And today, we're talking about a subject that's probably 20 years behind tax-deferred exchanges. When we start looking at these retirement accounts, what people can and can't do. But there's getting more and more pressure because people are seeing the opportunity. A couple of you expressed why you're here tonight. You need more than what the interest on the money is. If you got money sitting in the bank today, what's it going to give you? 0.2? Yeah, or 0, or maybe, as I mentioned yesterday, maybe they charge you for it. So it's a different world. But when we start looking at what you can get off the real estate, it's a different situation once again. So the second article that's just mentioned here, Fox Business, it comes up. The URLs for both those, if you want to read them, you can. The first one's a pretty good article, but it sort of misses the point because it talks about people aggregating funds to go buy things. And that's not what most of our clients are coming to do. Most of our clients are coming to convert their money into an account that allows them to go do things on their own, whether they're buying notes, making loans, buying real estate, whatever it is. Typically it's by themselves or maybe, a couple family members. But we'll talk about all those possibilities in a little while. So why do people do this? Tired of the stock market's roller coaster? It's not really a roller coaster today like it was a couple of years ago. Remember those 500-point swings that we used to have? Those we don't have that much anymore. But people are still tired of just watching it go up and down. Invest in what you know. I think that's something that's huge. The title page right at the bottom said invest in what you know. If you have a Wall Street investment and you have some specific knowledge, you think, gee, I'm going to go make this investment because I know this is going to happen. Can you legally do that? Ask Martha Stewart, and it's not okay. And I think it's ridiculous that she ends up the one that's in trouble for that. Because, what's a market maker do? What do they do for a living? When we had, anyone know Greenbrier Industries, right? So what happened last month with them? Icon came in, stirred it up. What did he do? He put a bunch of money in there, threatened to take it over. What happened to the stock? It goes up dramatically, and then he kills the deal. And he actually made somewhere between $3 and $5 million just doing it. And that's legal, and yet Martha Stewart is was in jail for a period of time. So if you're a mortgage broker and you want to make loans with your retirement account, you can do that. You as real estate professionals, if you want to take your retirement account and invest in the stuff that you work with day in, day out, you can do that. All right? So look at what you have and take as much gambling out of it as possible. Use your specific knowledge to make more money. Do what you want to do. All right? Real investments, not alternative investments. We talked about that. Take advantage of today's opportunities. The stock market, where was it today? Roughly 13.7, 13.8, somewhere in there, right? It went from 6,500 up to that. And why it's there, I don't know. How it'll stay there, I don't know. But I stopped guessing on that a long time ago. If we look at gold, where is it today? 16, 1,700, somewhere in there, near record highs. Real estate, on the other hand, a little different situation. Tangible assets, great hedges against inflation. Security. Why would I say security? Why would people self-direct for security? Well, if you go, once again, buy a piece of property, maybe if it's a rental house, you're not betting that it's going to go up in value. If you look at what you're dealing with, in an office building there. You know, he's got that one that cranked out. You got the client who's talking about it made, last I heard, $250,000 last year. One of them, maybe not the one. You're working on that one, I believe. But the numbers I saw, that's what it did last year. So it didn't have to go up in value to make him a nice return. But bottom line is it probably will over time. Might take a few years, but it's not going to go away. You buy gold at $1,700, is it going to go up? Is it going to go down? What's going to do that?
One of the caveat to that is that he is, and he owns it, for example. I mean, he's totally
debt free.
Yeah, debt free thing.
Yeah.
So any profit shows.
Exactly. So you're not gambling with it. It's something that's there, it's tangible. It's not going to go away. The other reason I say security here, you're not dealing with some brokerage. If you hear our radio ads, they say, you know, you're not dealing with some broker across the country. You're dealing with something right here. If you self-direct your account and you use a checkbook IRA, for example, you literally put the money in the bank of your choice. So I know there's a couple of Oswego people here. If you want to use Bank of Oswego, you can open up a checking account in the LLC's name at Bank of Oswego, and that's where the money is until you invest it in whatever you're going to do. So not only do you have the security of having the investment where you can see it, and touch it, and feel it, but you have the bank, the money where you want to put it. And that's something that's very comforting for people. This slide I've used in our presentations for the last few years. I just like it. But the bottom line is, where are we? If we look at real estate prices, where are we down there? You know, are we here? Are we here? Are we here? And I think the answer, you know, we say apartments, we're over here someplace, right? But you know, dirt, we're somewhere in here probably, and everything else is somewhere in between. If we're talking investment houses or houses, it depends where we're talking about in town and in what price range, correct? Across the country, we've got definitely a range there. But the thing is, and you know, we did some transactions with you. I believe one of the transactions we did with you was somebody was mad because they didn't get to show the house, right? I mean, the thing went on and off so fast that people were, you know, upset. So this is a, you know, that was over here. We had so many people chasing properties. Things were moving so fast. You asked for some time, you weren't going to get it. Well, today, people are happy to get the offer. So this evening, I was talking to somebody, and they're giving up multiple properties to buy one. I said, well, the biggest headache with any exchange is time. So a few years ago, if we would have said, Barbara, I want this property, but I'd like you to wait for 2 weeks, would you wait? No. Okay. Today, if I say, Barbara, I'd like the property, but you know, I can't close it for 60 days, you're going, thanks for the offer. You know, I mean, great. So it's a different deal. So what we see is, you know, the people that are waiting until over there, they're going to lose some of the flexibility, obviously, to make the deals. But you know, we've got cash buyers primarily that we're working with the retirement accounts. Don't have to be cash buyers, but most of them are. All right, and they've got the ability to time transit. You have no time constraints with a retirement account either. You buy a property when you want. You sell a property when you want. When you sell it, proceeds go back in the account. You don't have to buy anything. So unlike a 1031 exchange where you've got this ticking time bomb in some ways, you don't have anything here. Which for the brokers in the room might not be a good thing because there's no urgency to reinvest. But you know, for investors, I mean, it's a great thing in that you take your time. You do the deal when you want to do the deal, and everything's tax deferred. All right. So the other piece is I have a lot of people come and say, well, I'm going to keep my powder dry. You keep your powder dry too long, you're going to miss that opportunity there. And if you look at the interest rates too, we've got so many things. I've stopped guessing. I mean, I figured we'd have inflation by now. We haven't. I figured the interest rates would be up. You know, how could I be any more wrong? I mean, you guys probably ought to go home. But, you know, I mean, it's just at some point we've got to have inflation. And when we have inflation, you've all heard the ads on gold, right? What do they say? Tangible asset, inflationary hedge, da-da-da-da-da. What's real estate? Same thing. Everything that gold offers, real estate offers in spades. I think this one's pretty telling, this slide. This is from Stuart Title's chief economist. And, we all talk about returns on different things, but sample investment period, and I was a business major, took statistics, so I understand you take the right sample group, you can get the results you want. But from 1980 through today, gold's nominal return for that period is 95.5% with an inflation-corrected real return of negative 30.2. Housing's nominal return for the same period is 252% with an 18.6% positive inflation-corrected return. I think that says a little bit. So, this bottom sentence here, when Dave came in, we talked a little bit briefly about SunWest. Okay, so SunWest was a local company, had some problems that you in the real estate industry are probably aware of. Who bought them? Who bought that whole mess? World's largest private equity firm. What'd they do with it? They doubled their money in a little over a year's time. Okay, so we've had a lot of people come in, and institutional money's been chasing the property. Institutional money's already making a pile of money on all our property. And the general public's still sort of saying, gee, it might not be at the bottom yet. I don't want to sell now because we're going to have a loss. I don't want to buy now because it might not be at the bottom. Da, 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 da. If it's a good deal, it's a good deal. Make the offer that works for you. And that's what our IRA clients, 401k clients are coming in and saying, gee, I feel good about what's here. I can make this deal happen. I'm not comfortable with this or that, and this is what I want to do today. They look at their money and what's the highest best investment for their money, and that's why they're self-directed today, more than anything else. But if you look at the 2010, this few years ago now, $375 million was raised in private equity. And a lot of that stuff, if you look at securitized investments in this state, Norris, Beggs, and Simpson's done several big funds. They fully subscribe them, and that's just aggregating money from regular people. And that's chasing down stuff, and they're doing it, and we have a lot of the general public, like I said, that's sort of waiting around. So self-directed IRA. I told you I'd go to these classes, and I'd say, okay, I want to learn how to do this stuff. And I'd walk out, and I wouldn't have learned anything. And what I have to say is that it's not a legally defined term. When people come to us, they say, well, I'm going to pull my money. I want to pull my money out of the plan so I can go do this or that. But we're not pulling any money out of any plan. All we're doing is changing the custodian. You've done that. First thing we're going to do is change custodians. We're going to change to a custodian that allows truly self-directed accounts. Now, if I ask people in the room tonight, does anyone in here have a self-directed account? A couple of you might raise your hands, and I say, okay, with whom? And you might say, well, Fidelity. Well, Fidelity might, in their terms, consider it a self-directed plan, but it's going to offer their menu, their food choices, which is just a little tiny piece of what's possible. Okay, so when we talk about self-directed account, whether it's a 401k or an IRA, we're going to talk about an account that allows you to buy anything the law allows, and that menu is virtually limitless. So, it's not a legally defined term, it's just a term that describes an account that allows you to buy what you want to buy, and to do it when you want to do it. So what accounts can be used? 401ks, profit sharing plans, 457s, 403bs. The top group are all sort of rollovers. The bottom group, any existing IRA can become self-directed. So when we talk about that top group, the 401ks, we've got some parameters that we have to work with. And I was actually sort of surprised when you talk about your business that you have all IRAs, no 401ks. Is there a reason for that? No?
We're employee owned, and so we have stock, and we encourage people to buy stock in the company instead of.
Yeah, great. Well, I think 401ks, for a company owner, they're sort of a pain in the neck. And I've got to sort of say this about retirement accounts, period. I'm not a huge proponent of them. I think if you work for a company, and where I see people that have made a lot of money with them is when they get matches, corporate matches on those contributions. But if you take a piece of real estate, and if you pull money out of your pocket, go buy a Plex, let's say, you're going to have the income, you're going to get the depreciation, the interest deductions, you're going to get the cash flow, all today. When you go to sell that property at the end of the day, what happens? typically you're going to pay long-term capital gains taxes, or you'll pay nothing by doing a tax-deferred exchange. Pretty good situation. If your retirement account owns the property, you get none of that until you take the money out as a distribution, which if you take it out of a 401k or a traditional IRA, the money that goes in is tax deferred, but as the money comes out, you pay normal income tax. So a lot of people think, well, I'm going to sell them a retirement account. I'm not going to sell you a retirement account. I'm going to ask you what the best investment for your retirement account is. And if it's in Wall Street, in your opinion, then keep the money in Wall Street. If it's in real estate, great. If it's in notes, great. Whatever you want to do, and our accounts, once again, are going to allow you to make the Wall Street investments or keep the Wall Street investments, but they're going to allow you to do all kinds of other things too. So, that slide on Stewart title deal was sort of beating up gold a little bit. That's not to say gold's not a good investment right now, and if you want gold, the accounts are going to allow you to make that investment. So 401ks are sort of interesting because some of the plans don't even allow our investors or employees to go to cash. So we had a client come in prior. He had actually come and quit his job to get access to his funds because his 401k plan would not allow him to go to cash. And this was before the market tanked. And he just said, I don't want to work for the next 10 years getting back to where I was. So literally had to quit his job. I had recently, we had a gentleman call up and says, I'm unemployed right now, so I'm going to roll my 401k into an IRA. Well, he was going to go start working again in the same company that he just, quit. Well, how'd that come up? Well, the CFO for the company said that the boss did it and suggested I do it to get access to the money. Boss wanted the money to self-direct, go do some other things. The only way to do it is step away from the company. So, I'm not going to say to do that, obviously, but, that's up to you, and that's sort of an extreme measure, but that's possible. So most 401k plans don't allow you to self-direct. But if you are 59 and a half, you can take what's called an in-service distribution. But if you're happily employed, you've got a 401k plan, and you're under 59 and a half, we're probably not going to help you. Not going to be able to help you. The money's sort of stuck there. 59 and a half, you can take the money out and roll it into an IRA. We can go do what you want to do there. All right, any questions on that? Happily employed, under 59 and a half, the money's probably stuck.
So if I've taken my 401, obviously
you said you're retired.
Right, so it's just with my broker.
Yep. So now you're fine.
No restrictions there.
Correct. You are fine.
Okay,
yeah. All right. But that's just one of those things that, it comes up all the time. And it's, it is what it is. Short of the company changing their 401k plan to allow people to self-direct or amending it that would allow self-direction, which just doesn't happen. It is what it is.